Hey guys, today I want to talk about a few news stories that have popped up that are crucial to the public account, stocks that I have in the public account. So these news stories are very interesting. I saw them and I was like, wow, I really need to talk about these. I wanted to conclude this video with a analysis of Alibaba, and I'm going to use my software that I've been developing, the beta version of it, to analyze Baba and see if it's a good buy at this point in time. I may or may not start a tracker position, but I will get into that into this video and see if, and you guys can see if I chose to buy it or not by watching till the end of this video. So with all that, that's an action-packed video. So let's get into it. Make sure that you like and subscribe. Again, like I mentioned in the last video, like 92 to 95% of people watching my videos do not subscribe and like or even comment or engage with these videos in any type of way. So it would really mean a lot to me if you guys like and subscribe and add a comment if you feel necessary to do so. But with that, let's get into it. The first news story that I want to talk about is FICO, and I've talked about FICO in a previous video, and I mentioned how if another agency or company is allowed to, or another scoring system is allowed to persist or encouraged, that FICO's main revenue source will be diminished or, attacked. And that's exactly what happened. So I'm looking at this CNBC article, and it says that FICO has been sliding, and it did slide 6.5% yesterday, marking a second straight day of losing, because the Bill Pulte said that Fannie and Freddie would be allowed to use VantageScore 4.0 to determine a borrower's creditworthiness. This is huge. This is kind of what I was mentioning in the previous video a few weeks ago, and VantageScore is a competitor to Fair Isaac Scores. So now the competition has increased, and you can see the drop. So if we look at FICO on the charts, you can see this precipitous decline from 2200 to maybe 1480 when the news first broke out, and then you see it kind of rebounded up to maybe 1900, 1940, and then now that the actual implementation of that competition has occurred, it nosedived from 1900 to 1500, almost back to the lows from the initial news. So yeah, this is kind of what I was talking about when I mentioned it back here when I made the first video, that this is what to expect. Their revenue is getting disrupted. Their major revenue is getting disrupted here. The next article that I want to talk about is OpenAI challenging Google Chrome with the new web browser they're going to release in the next few weeks. Now, this stuck out to me because just like the FICO example, where VantageScore 4 is being used to challenge their highest revenue generating segment for the scores, here OpenAI is challenging Google with their highest revenue generating segment, which is Google search, by introducing a new web browser. So my thoughts around this is that it is a possible important competition for Google, but right now OpenAI only has about 400 million weekly active users for ChatGPT, and compared to 3 billion users of Google Chrome. So I think that right now it's not an intense competition. I think OpenAI has to work really hard to get bigger and bigger shares of the addressable market, but they're not acting like they're not a monopoly right now. They used to be the only game in town with OpenAI and with ChatGPT, but nowadays Google has answered the call of AI. They have integrated Gemini models into their existing search. They introduced AI mode. They introduced AI overviews in the regular search. and they have their full suite of, just chat GPT equivalents or betters in Gemini 2.5 and things like that. So they weren't sitting still when OpenAI was coming out with all this stuff. And now OpenAI is trying to, kind of trying to attack back with a web browser version of ChatGPT. I don't really see the mass exodus from like Google search to to a would-be web browser from OpenAI. What would be the point? It would just, if 400 million people are using ChatGPT right now on a weekly basis, what's the impetus for those 400 million people to start using a web version of it? They will just continue to use the ChatGPT version, which is available through the web. I don't understand the reasoning behind this one. So for all those reasons and more, I think that Google is okay at this point. I think I'm still not pressured to, I'm not going to be selling my Google shares anytime soon. Plus, Google has more than just, their search, even though that is their biggest revenue generator. They have Waymo, they have YouTube, they have other things in the pipeline that will also increase their revenues. So, Google Cloud is increasing, and they're fighting actively against AWS and Microsoft Azure and gaining market traction, and they're increasing their profits and revenue from that. So I am not afraid as a Google shareholder, and I will continue to hold it in the public account. And I think it's a news story that I want to keep close eye on, but I want to see if OpenAI is able to gain greater market share from search, from Google, from all the other players in that space. The final story that I wanted to cover is the Pentagon is going to become the biggest shareholder in rare earth miner MP Materials company, and their shares surged 50% today. So the Defense Department is going to be buying $400 million of preferred stock in MP Materials. They're basically backing and subsidizing their company. The Pentagon will guarantee a price floor for 10 years at $110 per kilogram of NdPr products, which NdPr is probably the chemical composition of that material, and to be stockpiled or sold by MP Materials. That is a amazing subsidy for that one company, because they're primarily the monopoly in the US for rare earths. But the reason overall this is great news for MP Materials specifically, but also recently the government has announced that coal, metallurgical coal, is a critical mineral. And so these type of news stories lend credence to the fact that the government is going to be subsidizing and protecting these type of critical mineral and rare earth plays in the US, if they're based in the US. So if you want to see the impact of this on other mining material and mineral companies, just look at what's happening to HCC. This is in the public portfolio, and it hit a recent floor of $40.70, and now it's all the way up to, it hit almost $53. And it hasn't even, this is not even the thesis that I was talking about for next year and following years after 2026, where they're introducing Blue Creek and all of that stuff. This is just from news events of government subsidies and just supporting the mining and mineral industry. So this is pretty amazing to see. I wasn't expecting this, but it is a welcome sight. I did want to pick up some more while it was stayed under 50. So for right now, I'm not going to be buying any more of this. But it is interesting news nonetheless. And that would explain the price rise from here to here. It's pretty good. It's almost 25%. Let's do the measurement. From here to here, yeah, 30%. A 30% increase so far, which is pretty amazing. Let's go to my software that I built. This software is in beta. It's going to be available through beardedinvestor.com. It's not quite ready for public consumption yet, but I wanted to give you guys a inkling of what the software does, what it's for, what's the purpose, who is it useful to, and what you can get, what value you can get from it. So I'm just going to I created a simple login. So here's the software, and today we're going to be analyzing BABA. So I'm going to type in BABA into the search ticker, and you'll see that on the left hand side you'll have company overview, past performance, which is the data visualizations, charting. You're going to have PEG and PEGI ratios, the calculator. So PEG and PEGI stand for price to earnings over growth rate and price to earnings over growth rate and dividend yield. So PEG and PEGI allow you to do a quick visualization on the company valuation. You can quickly see if a company is overvalued, undervalued, or fairly valued. And the ratio will be between 0 and 1. It means the company is undervalued, and anything above 1, it means it's overvalued. And this tool will allow you to see that at a snap of a finger, and also change the values, the current values that produce that ratio, just in case you have some assumptions going forward into the future. Maybe the PE drops or the PE increases, maybe the growth rate expands rapidly for the next year or something like that. This tool will allow you to change those parameters and figure out what the new PEG and PEGI ratios are. Maybe whatever you change will make it overvalued, or maybe whatever will happen will convert it from overvalued to undervalued. Maybe its growth rate will increase a lot and it'll become undervalued the next year, even though it's overvalued now. So this tool will let you figure that out. And then you have key metric valuations. And this is your price to earnings, your price to sales, price to book, EV to EBITDA, your free cash flow yield. These metrics are very key metrics for all companies, but which key metrics you use to analyze a company depends on the company type, the industry, whether they're profitable or not. So once we get to that section for Alibaba, I'll describe that in more detail. And then finally, you have intrinsic valuation, which is the bread and butter of this tool, basically. And for value investors, people who have years time frame and time horizon, it's a very complex calculation that will discount at a percentage that is custom to each company, discount future cash flows to the present day value. So a key tenet in value investing is that any company, all companies, their intrinsic value, their fair value, is the sum of all their future cash flows discounted to the present day value. So that is what this tool does. And it's a 4-model calculation. So it's really insanely complex, and it took me months to make. And I'm still working on it. That's why this is still in beta. But you have your 2-stage DCF models. You have your adjusted flow from operations model. You have your dividend discount model, and you have an excess return model. And there's 4 models because each model is tailor-made to a specific type of company. For example, if you have a bank like Bank of America or JPM, those wouldn't be using the 2-stage discounted cash flow model. They would use the excess return model because those are better suited to analyze and value bank stocks or financial stocks. If you have a REIT, a real estate investment trust, those cannot be analyzed with a 2-stage discounted cash flow model. They have to use a adjusted flow from operations model. So because of these things, these different models exist, and this tool provides them all and intelligently picks out the right one based on the company that you're analyzing. So with that, let's get into it. And let me restart this. But yeah, so the first thing you'll notice here is all the financial data has been converted from CNY to USD for Alibaba. And that's because it's an ADR, and some of the data that's been reported is in CNY and not USD. So I've made a currency conversion for all companies, a real-time currency conversion for all companies, including foreign companies that are ADRs, which are American Depository Receipts, that trade on US stock exchanges, so that I can have a standard USD analysis of all companies. But you won't see this on American companies because they're already reported in USD. So first you'll have a company overview, and you'll have a detailed company description, which you can read. It tells you what they do, who their customers are, what their services and products are if they have them, and just overall general view. Sourced from 10Ks that the company files with the SEC. Then you have your current price, your market cap, and your shares outstanding. And the shares outstanding is a smart shares outstanding. So if you're valuing a company like Google, which has different shares, classes of shares, this shares outstanding will only take the current ticker symbol that you're using. But in the intrinsic valuation section, it will use the combined class shares. So it's smart like that, so it can figure out the actual value. But here, what you're doing is just looking at the ticker, so it gives you that that price. And then you have a price chart just to see what the trend is for the price for the last 10 years. Then moving on to the past performance section, this is the data visualization section. So here you can get your metrics and see what the trend is for any company. So for Alibaba, you can see the annual metrics. For revenue, it looks like it's going in the right direction. Net income, it's been going up since 2021 or 2022. EBITDA, the same, obviously, because that's based off net income. Free cash flow, you can see it's declining here. That's most likely either due to share buybacks and or CapEx spend, capital expenditures. Then you have your cash to debt, so you can see, compare their cash, their total debt, what their balance sheet is like, your expenses, and you can even you can see the amounts of each expense for their company, and the total amount of expenses, and you can filter it down like this if you need to, and then hover to get the actual amount. Then moving on, you have dividend per share. Baba started doing dividends in 2023, and you can see the amounts over the years. Shares outstanding, they've been buying back shares like crazy. So you can see a nice steep decline here in their shares outstanding. They had 2.75 billion outstanding shares in 2021. Now they have 2.41 billion in 2025. They've been buying back like crazy, and EPS has been growing in the right direction, in upward. So based on all of this, it looks pretty good for Alibaba. I did want to point out that you can look at this in a quarterly timescale, and also you can, for a quick way to look at stuff, I've segmented this out to growth, profitability, financial health, and dividends and capital. So if you want to look how much are they paying in dividends, you can just click on this and it'll give you the filter down the charts to the exact charts that you're looking for. And if they're buying back shares, if they're giving dividend returns on this company. So moving on, here we have the PEG and PEGI ratio calculator, and this is super important. Like I mentioned, anything under one is undervalued, and you can see both PEG and PEGI ratio for Alibaba is undervalued, 0.83 and 0.79. The difference here, why PEG and PEGI ratios are different, is because BABA pays a dividend of 0.93%. So that makes it even cheaper, even more undervalued when you look at the PEGI ratio for this company. But you can also change this to see, let's say they increase their dividends to, and their dividend yield to 3%. You can see how this gets even more undervalued and even a better buy at that time. So the metric valuations here, and here, since BABA is a mature, profitable company, usually you would use the PE ratio to compare this company to other companies in the same industry. And that's what we would do here. And the PE is 13.9, which is pretty cheap compared to other big tech companies in the US. And I think that's the China discount coming into play here. Because if you look at Amazon or some other, Google or something, it'll be closer to 20 or 30 for their PE ratio, trailing 12 month. So that's really good, and that's another plus for buying BABA. The other ratios here, the price to book ratio, the price to sales ratio, EV to EBITDA, free cash flow. Free cash flow is very important to look at in all companies, and this is a very nice percentage of free cash flow yield. We're making a lot of money at the end of the day. But the price to book, price to sales, EV to EBITDA, EV to sales, those aren't always relevant to all companies. Since it's a profitable company, Alibaba doesn't need to look at that. But if you had a bank or a financial company or a REIT or something else that's a different type of company altogether, you might want to look at some of these different, like price to book might be more relevant metric to look at than price to earnings. Also, if they're not profitable, you'll have a not applicable here because there's no positive earnings to make this ratio. So at that point, you'll have to use one of these other metrics to evaluate that company versus its peers. And then finally here is the advanced DCF modeling software that I've built. And basically what it does, it has current price and it compares it to the fair value. Like I said, this is a summation of the future cash flows discounted to the present day value of those cash flows. And so here we're getting a 76.7% undervalued for Alibaba, which makes it a great buy. Obviously, none of this is financial advice. This software is for educational purposes only and to give investors an idea and edge in their own due diligence. So use it as a tool. This is still in beta, so we're still working out the kinks and stuff like that, but it will be available in the next few weeks when I get this complete. Here you can see the assumptions for this DCF model, intrinsic value. We're using a two-stage free cash flow to equity valuation model. It is using a levered cash flow, free cash flow. We calculate a discount rate, a cost of equity, and have a perpetual growth rate that is equivalent to the 5-year average of a 10-year treasury bond, which is the industry standard practice. So here we have all the calculations necessary for that. So you can fully see where this number came from and gives you a breakdown of all the different points, coefficients, constants, variables, everything that's used in the calculation. It gives you a full breakdown of it in a nice, easy tabled format. In here we use betas from industry average from Oswald's industry chart. And we take the unlevered beta, we re-lever it using a standard formulation and use that levered beta in the calculation. So here you can see from 2026 to 2035, 10 years of free cash flows, which are discounted at that discount rate that was calculated above for each of those years. and then we get a present value of the next 10 years, and then we calculate the final terminal value, add that together, and divide by shares outstanding to get the $183.5 price target for Alibaba, which is a 76.7% discount. So that's the idea behind here. And I'm still working on this DCF model, making sure, testing over and over and over again to make sure it works for all models. But yeah, based on everything I've seen from my software here, I think Alibaba will be a great purchase at the current price. And I did this analysis a little while ago in the morning, and I saw that it was a good buy. So I made a tracker position. I bought a tracker position for Alibaba in the public account, just about $100, because that's what I had from the dividends that I got a few weeks ago. So yeah, I bought some Alibaba, made a tracker position for it, and that's in the public account now. So I'm excited about that. So in the future, in the next week or so, I'll have a portfolio update for July. So I'll talk about that in that segment. And that's it, guys. So this is the software. I hope you guys like it. And if you guys want to see some new functionality or other functionality that's not here, please let me know in the comments below. And I'm hoping to get this out to you guys in the next few weeks, and it'll be available under a membership at beardedinvestor.com. If you want to use it and support the channel and support me, that would be really appreciated. I would really appreciate that. And like and subscribe, and I'll see you guys in the next one.